Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Qualcomm and Arm out with their earnings. We'll break them down with the two CEOs, Cristiano Amon and Rene Haas.
Plus, Alphabet's Capex mic drop. Record spending plans hit the stock despite strong earnings.
And Bitcoin falls below $70,000 for the first time since late 2024. We'll break down the negative momentum impacting crypto markets.
And that negative momentum is affecting markets more broadly at the moment. Check out the Nasdaq, off by 1.4%. We are trading the lowest since November right now at the moment, Ed. We are seeing pain across the board, and that's why we've got to go to our Bloomberg's cross-asset reporter. I'm pleased to say we can dig into all of these moves across asset classes with Alexandra Semenova, who's with us now. I don't know where to look at the moment. Everything is in the red.
It has been a really ugly week, Caroline. We have obviously seen corrections in tech over the last 3 years since the launch of ChatGPT, but nothing has rivaled the sheer magnitude of this sell-off that we're seeing in the sector across various assets, hitting both stock and credit markets. Software stocks, of course, have been at the forefront of this. They are down about 15% this week and 29% from their all-time highs in September. It's also important to note that this sell-off has triggered a number of extreme levels from a technical perspective. The share of software stocks at oversold levels eclipsed 70% yesterday. That is an all-time high in the broader tech sector. That share is about 45%, also a record. And another barometer of how painful it has been, the iShares Expanded Tech Software ETV, that is ticker IGV, compared to the S&P 500, is the most oversold that it has ever been. And of course, that risk-off sentiment is spreading today. What we've seen so far is that it has really been focused on tech. So up until today, it's really been a rotation out of tech and into other pockets of the market. And now we're really seeing the sell-off broaden out. Looking at the S&P 500, it is down 1.2% right now. The Dow Jones Industrial Average, which up until today has been kind of shielded from this, is now down 1.2%. Also, the S&P equal weight yesterday, for example, was up 0.9%, even as the broader market sold off. It is down again today. So really risk off across the board. And we have to talk, of course, about Bitcoin. It fell below 68,000 today, which is the lowest since November 2024, down about 45% from its October high. Also big news today that crypto exchange Gemini plans to cut about 25% of its workforce. So really seeing the pain of that.
Bloomberg's Alexandra Semenova with the macro picture at the index level. This is what matters when it comes to technology earnings. Caroline called it the mic drop moment. Alphabet, parent of Google, with a Capex forecast for the fiscal year of $185 billion. The street had forecast just shy of $120 billion. That's a bit of a delta. The stock down almost 5%, on track for its biggest drop since May of last year. A big number to digest. Earnings also in the chip sector. Qualcomm down almost 8%. It gave a forecast for the current period, $11 billion in sales at the top end. How much better would that have been were it not for the impact of what's happening in memory chips right now in the memory market? Arm similarly, but actually it is up 5 percentage points and it's accelerated throughout the session. Sales in fiscal fourth quarter will be about $1.47 billion, just ahead of consensus. How are they managing what's happening in the memory shortage? And when are they going to transition from the handset story to the data center story? Let's talk through it. Arm CEO Rene Haas joins us now. Rene, good morning. Thank you for joining us. There is a lot going on. Let's get the sort of handset, smartphone and memory situation out of the way, if that's okay. You know, clearly this is impacting outlook for the smartphone market across this calendar year. How do you think it showed up in the earnings that you posted? And would it have been slightly better if the situation were different?
Yeah, good morning. Good morning, Ed. So first off, the quarter was amazing for us. We had not only record revenue, but record royalties, $1.24 billion in revenue, nearly $740 million in royalties. And if you just stack that up, that's 27% year on year. Our data center business is exploding. We were up 100% year on year, probably north of 100% year on year. So to your question, no, the memory situation isn't really impacting ARM so directly. And you might ask, well, why is that? Well, number one, we are spread across a lot of different businesses. As I said, the data center business is increasingly growing for us. And we think in a few years, it'll be our largest business. Secondly, our products are used across the board So what we tend to see in memory shortages is the bottom end of the stack starts to get impacted, and that's actually lower royalty rates for us. So as a result, we don't get impacted very much. So no, short answer is no impact this quarter. And we raised our guidance for the next quarter because, as I said, we're just not seeing that kind of impact. But I'm not denying that it's there, but for the ARM business, the impact is quite minimal.
Rene, thank you for that. Data center royalty revenue grown 100% year on year, as you outlined. I get the same question for you from everyone, sell side through to buy side, which is give me a specific year, mark it on the calendar, when ARM goes from being handset to data center and it accounts for more of your business. Is that inflection point clear on your calendar at least?
It's very clear, and that's why in the earnings call I said in a few years. As you know, we don't typically provide forward guidance on an annual basis, but we have a line of sight that says we see it coming. And it's probably coming sooner than we had thought. And the reason for that is the data center growth. But if you click below that, why is data center growing so rapidly? It is the presence of ARM CPUs in the data center. We're now over 50% market share at the hyperscalers. Secondly, the CPUs that are being used are using more ARM CPUs inside the chip. 192 cores, for example, inside a Graviton chip, going from 96. NVIDIA Vera going from 72 cores on Grace now to 88. So what does that mean? That means more cores means more royalties and high growth rate. Well, why are there more cores? When you think about agentic AI and everything associated with agents moving workloads across systems, managing workflows, et cetera, that's the kind of work only CPUs can do. So to your question, while we're not giving a date, we can see it, and it's coming sooner than we had thought, even probably 6 to 9 months ago.
And probably on the back of when you look at an Alphabet increasing its capital expenditure by another, well, potentially $185 billion, Rene. Is the AI bubble, this worry about AI infrastructure build out, a thing of the past to you, or there are still some bottleneck issues that you're concerned about?
Yeah, so it's a great observation, Caroline. And yes, there's huge growth in Google's Capex. Not all of that $180 billion is coming to us, of course. But what does that say? We continue to see investments in the data center, whether it's what Meta had announced or Microsoft announced, and now Google, Alphabet, that exceed what people had originally thought was even possible, even a couple years ago. If you go back to when we announced the Stargate initiative in January of 2024, $500 billion over a number of years, people looked at those numbers and said, how is that even possible? Now 18 months later, it looks quite credible. So bottom line is we are seeing such an investment because the AI opportunity, the way I like to think about it, is kind of the final frontier relative to technology. When you think about what could be beyond AI, it's really hard to imagine. So also the fact that AI has really had very little penetration, let's say into large enterprise or into our health systems or things around drug discovery. So there's a long runway. I think people are a little nervous about it, as decidedly so, because we've just not seen it before, right? We've not seen the order of magnitude we're talking about. So it's somewhat natural for you to look at it and say, well, gravity's got to hit it sometime. But then if you intellectually look at it and say, my gosh, is AI going to be something that will change and transform how everything is done? Well, of course. And then there's going to be investment to support that. And that's what we're seeing.
Investment to support that. We mentioned Stargate. That immediately makes me think of Massa. And you were clear on the call yesterday that you've spoken to him. You don't think SoftBank is in any way going to sell down its stake in ARM. But how much is that an overhang in the longer term? And how much actually do you want to see more free float of your stock?
Well, I have one very large shareholder who I talk to quite frequently who loves ARM, and he's very long on ARM. So he has no intention to sell at all, and I shouldn't even say anytime soon. I don't know when that would be, quite frankly. We do talk about it. He said he's got no interest in selling. How that impacts the float, et cetera, that's not something, candidly, I spend a whole lot of bandwidth thinking about. But he's very long on ARM because he sees the enormous opportunity that we have. And if you think about what we've done since we've gone public, Caroline, in the fall of 2023, We told the world we'd be growing at 25% year on year for 2-3 years, and people didn't believe it was possible. Here we are now a couple of years later, and we're beyond what we told investors during our roadshow, and things are even stronger than they were at that time. So as a result, he sees it. He sees probably more of the data than anyone does, and that's why he's not selling.
Rene, I want to go back to CPU. January 26th, Bloomberg speaks to NVIDIA CEO Jensen Huang, and he speaks for the first time about selling to the market via a CPU as a standalone. And that seemed critically important because if you think about the pipeline for Blackwell and Rubin, right, those are GPUs coded in ARM-based architecture. And those building, they don't want to sort of have to cross-pollinate x86-based platforms with their ARM-based GPUs. It seemed to be really substantive. Could you explain how much of a boost that was for ARM and whether this idea that the Vera CPU goes into the market as a standalone product changes the trajectory at all? Because at the same time, NVIDIA talks up about how much content it owns proportionally in the overall system. Just take it and run with it, please.
Yeah, so first off, thrilled to see Jensen say that. They're a great partner, and Vera is a great product. And as I mentioned earlier, Vera's gone now 88 CPUs inside it, CPU cores from 72. So why is that a really good thing for us going forward? Well, primarily because when you think about the data centers and how they're evolving from what is general purpose compute, moving to AI compute, a mix of training and inference, and those inference workloads are agentic, that's right down the center of the plate for what the CPU not only is good at, but can only do. So what that means is inside the data center, you're going to start to see movement towards a homogeneous type of structure where people would love to have the ARM stack running almost everything. It's just easier from a maintenance standpoint. It's easier from an upgrade standpoint. It's easier from a cost standpoint. So, and also the flexibility it can afford. You can build a tremendously efficient custom system based on ARM. The Vera Rubin platform, Ed, compared to Grace Blackwell, uses 6x the number of CPUs. And that's when you look at the storage, the DPU, the offload. That's a huge increase.
Yeah.
So yes, selling loose Veras, that's a great thing. We're super happy to see that.
Briefly, Rene, you have such a bird's eye perspective because you're working with NVIDIA, but also you're working with OpenAI. It was reported potentially was looking with you at your technology to be working with its own custom chip with Broadcom. You've got Meta looking at custom chips, of course. How do you see this evolving?
Yeah, I have a lucky job. I get to work with just about everybody in the industry across the planet, whether it's in the fab foundry area, whether it is a chip company, whether it's an OEM, whether it's a software provider. We work and talk to everyone because ARM is just so pervasive. The common theme we see is continued investment in AI, and not just at the data center. It's trying to figure out how do you run those AI workloads everywhere. How do you run them in wearables? How do you continue to make them more efficient in a smartphone or a PC, or in physical AI, whether it's autonomous driving and or robotics? So we're involved in all the conversations, and the common theme is heavy investment. And one of the challenges that we see in the chip world around this is, as you know, it takes a couple years to build a chip. The IP that we develop that goes into the chips, maybe a couple years in before it, trying to predict what the architectures look like 4 years after the chip has been designed, where the AI models are going, is really very tricky. That lends itself also, though, very well to ARM because we are programmable, we are flexible, and we are low power, meaning that wherever the chips drop, no pun intended, we should be in a very good position to be able to drive those workloads.
ARM CEO Rene Haas, with the broader perspective, we thank you for it. Now, coming up, we've got more earnings to talk about. Alphabet's results. Expectations for Amazon. It's coming thick and fast, folks. This is Bloomberg Tech. Record spending by cloud providers. Well, it's raining on the parade of big tech earnings following Alphabet's results last night. Let's talk it through with Ayoko Yoshioka, who's here with Wealth Enhancement Group. Ayoko, it looked at one point after the announcement yesterday that we were going the way of Meta, that even though Capex was going up, we were celebrating the AI rewards and the revenue boost. And then we went more the way of Microsoft, and we were worrying about the extent of the Capex. Are you selling on this?
No, Caroline, we're not selling on this. You know, these companies are still high quality companies and they're still growing very quickly. I think it's just an adjustment from a valuation standpoint in terms of what are these companies worth over the long term? How much longer are they going to be spending at these levels? Because the issue for investors is really just the sort of collapse in free cash flow that we, have been just grown accustomed to. These companies used to return so much of that free cash flow to shareholders, and now it's being spent for investment for good reason. And over the long term, this should help them grow. However, it just means that the investor kind of gets put to the side for a little bit.
Are you worried in any way about the free cash flow that Alphabet is perhaps taking a hit on? Because from what we could understand from the numbers, in fact, they're becoming ever more efficient. The margin is being supported because they're so vertically integrated. They're able to cash in on growing cloud and focus on compute much more than rivals, per se.
Absolutely. I mean, with the cloud business growing 48%, well beyond what investors were expecting at around 30%. If that continues, the investment that they're doing is justified. And I think investors will eventually reward them for that. It's just in the meantime, just recalibrating really what you want to pay. And the momentum had been so strong for Alphabet going into earnings that there's just a little bit of a, take profit attitude going on in markets.
Right. Okay, Yoko, let's bring back the capital expenditures chart. Wait for some TV magic. It's going to appear any second. And then you look at that and you go, my goodness. It is, Caro called it a mic drop moment. It is shocking. But what you said a moment ago, Google Cloud growing at 48%. Like, the whole Microsoft anxiety was that Azure was off by a percentage point. Why is Alphabet not getting the credit for the Google Cloud growth and everyone's just staring at that chart?
It's a great question. I mean, Microsoft missed by 0.4%. They posted 39% instead of 39.4%. Yet Google really sort of blew it out of the water. And, I really feel like it's that focus on that Capex spend in 2026 more so than anything else. It's great that we're seeing that growth on the cloud for both Microsoft and for Alphabet. But really, it's that spend in order to get those growth numbers, I think, is what is giving investors a little pause.
Amazon's down 4%. How much is that just anxiety about what they will or won't need to say tonight?
Absolutely. I think a lot of it has to do with the anxiety about what they'll say tonight and how much investors might be off or the street might be off in terms of the estimate for 2026 Capex for Amazon. I think investors are anticipating about $125 billion in spend, which is up 22% or so from 2025. And so we'll have to see if Amazon decides to spend a little bit more.
Yoko Yoshioka, Wealth Enhancement Group. Really good summary of what's going on in the Mag 7. Thank you so much. Now, coming up, AI tools keep coming for the enterprise software market. But will they be the existential threat that investors fear? We've got more on that next. This is Bloomberg Tech.
Well, it's introducing a new platform to help companies deploy AI agents more easily and pave the way for broader adoption among corporate customers. The new product, called Frontier, allows organizations to build and manage those AI tools so that each agent has appropriate guardrails and data access. Ed, what have you got?
Speaking of the enterprise shakeup caused by AI, Anthropic's legal plugin for its Claude Cowork may not be as devastating a blow to legal solutions providers. That's according to research from John Davies at Bloomberg Intelligence, who joins us now. John, as someone that suffered through years of law school and was born to two attorneys, I enjoyed reading it. Your conclusion is that Claude Legal is insufficiently expert to mount a challenge. Just dig a bit deeper into your thesis.
Absolutely, and hello. I think the key thing is that all these generic tools don't have access to the vast pools of data which the very specialized tools which the established companies have access to, which they've built up really over many decades, even centuries in some cases, and they're not easily replicable sets of data. It's a lot of shoe leather involved. You've got to visit vast numbers of courthouses, and it's not simply a question of digitizing the information. You've also got to put it in context. So the companies we're talking about here, Westlaw and LexisNexis, each employ many hundreds of legal professionals and have done for a very long time. And all that information is caught up inside their products. And that's the thing which I think the generic tools won't have access to, don't have access to, and therefore they're more likely to make mistakes, to hallucinate, to lead people astray. And you can't really work this stuff out from first principles because sometimes the law defies logic. It's not really like a science problem.
Hear, hear.
Defies logic. It's interesting, John, that in many ways, look, Claude Co-work had said that in a statement. They said, look, you still need a human in the loop. We're not suggesting this should just run wildly free. And in particular, we had an investor on yesterday, Uday Chiruvu, who's from Harding Loevner, who was saying the thing with LexisNexis, though, is that it's a point solution. It's not a platform solution. And that's why people had the anxiety that it might be knocked out in such a way. What more could we see from these AI developments that might give you pause about a LexisNexis or whoever's being competed against?
I think if they do somehow manage to gain access to data, and clearly, while it's expensive to replicate, these companies have a vast amount of money. So that could be one angle. And I guess the other one is if in some way it's a bit like proving a negative, but if they can somehow prove that they're no longer hallucinating, then they can point to where they don't have the knowledge and say, okay, beyond this point, you need as a lawyer to go and do the work yourself. But here is the kind of basic tool set. That could become quite a useful product, which could be sold perhaps at a much lower cost than the incumbent providers have at the moment. But it really seems like quite a stretch, and there's an enormous amount of experience built into the use of the existing products.
Right.
People have been using them for decades, much like they have various tools in financial markets.
And your notes point out they've also been enthusiastic adopters of AI themselves, so have been majorly innovating too. John Davies of Bloomberg Intelligence is a great note. Thanks for bringing it to us. Meanwhile, coming up, we've got to talk about crypto, increasingly under pressure. We'll break down what's behind these moves next. This is Bloomberg Tech.
Welcome back to Bloomberg Tech. In the last 30 minutes or so, actually, markets have come off session lows. The Nasdaq 100 is down 0.9%, had been down about 1.8% and trading at its lowest level since November. We'll keep an eye out on the Bloomberg terminal. I'm not really sure what the news flow is. Maybe this is just a kind of market sentiment thing that's going on. Earnings, though, of course, are a big factor in it. We talked about Alphabet, which itself is on track for its worst day since May. After the bell, we get Amazon. And Amazon's down 4%, right? You don't usually see a name that's going to report earnings after the bell decline with that conviction. Usually you're treading water. But because Alphabet, the parent of Google, posted such a monster capital expenditures forecast for this year, $185 billion, maybe there's some read-through there, Karen. Maybe the market's like, oh, wow, what's Amazon going to say? Like, what do we think's coming here? And of course, we're bracing.
Yeah, we're bracing. Meanwhile, well, if you were bracing for crypto to be falling further, you got that delivered. We're off by 6% today. We're below the important $70,000 level, and that negative momentum is just accelerating across cryptocurrencies writ large. Look, it's driven maybe in part by vanishing marginal demand amid this week's volatility in other areas, tech equities, precious metals. Bloomberg's crypto reporter, Mayo Shen, joins us now. Mayo, is this people selling crypto to cover losses elsewhere? Is it more fundamental than that?
Right now, it feels like there's some more fundamental issues within the crypto industry now. Based on what I'm talking, like everyone I'm talking to in the crypto industry, there's a crisis of faith, right? Like, digital currencies like promise of like we build this like internet money, and that's kind of despairing because like when prices are going down of asset class that's supposed to be going up. That's like really hard to sell at the moment.
So as
right?
a store of value, it's
Yes.
sort of losing faith.
Yeah, not just Bitcoin as a digital gold, also other cryptocurrencies, right? Like you see, like Ethereum, Solana, all these blockchains and crypto are supposed to sort of rebuild the Wall Street and rebuild fintech and neobank and whatsoever. But that's not really happening right now. Even if they're happening, as we're seeing some adoption from Wall Street, for example, right? We saw big institutions are getting into the space, but that's also not affecting prices. I think that's a big puzzle for the industry to resolve at the moment.
I think you wrote a really excellent summary using data in the chart that actually, for all the hype around Bitcoin, if you compare to other asset classes, it has lagged, not just in the short term, but on a longer term basis. Just explain the reporting.
I think the issue is that, Bitcoin is supposed to be like the digital gold. But what's happening, again, as I just mentioned to Caroline, that is we have this digital gold, that price is supposed to go up. But we are seeing that gold and silver prices are going up. But meanwhile, Bitcoin is selling. That's the issue of crypto, right? Like you don't have a fundamental happening right now that's proving what all the Bitcoin fans are trying to sell to the market at the moment.
Right, Bloomberg's Mona Shen, thank you very much. Another source of pain right now, software debt. In just 4 weeks, nearly $18 billion in loans has been pushed into distressed territory, the highest level since October 2022. For more, Bloomberg Americans finance editor Sally Bakewell joins us. Sally, there's enough anxiety and concern in the market right now with software before we even started writing about the debt pile. But it's the smart thing to do. Explain what's at issue here, right, in that kind of milestone that I just read out.
So I think the big question here for debt investors, for the market more broadly, is how much of this sell-off in loans that are tied to software is justified. Now, that's the big question that we can get to, but in the meantime, it is providing a lot of potential opportunities for investors who are scouring the market, looking for companies that are sort of good software loans, i.e. that can withstand and maybe even benefit from AI, versus those that are likely to be made obsolete or have their revenues severely stressed by AI. So that's sort of the big question. And what is interesting is the sort of spirited defense that some of the loan buying community, some of the biggest loan buyers have come out with. Ares said some interesting things on its earnings call that there are different kinds of companies, and a lot of them will benefit from AI, and that AI cannot actually replicate a database. It cannot replicate proprietary data. And so if you build a software portfolio around elements like that, you can actually build a portfolio that's resistant to AI and actually will benefit from it.
In fact, Mike Arrighetti joined earlier shows today, the CEO of Ares, talking about people are not really understanding how senior and safe a lot of these loans are as well. Is this a case of sort of throwing the baby out with the bathwater, or when are we starting to potentially see people getting more nuanced on which loans are exposed, which software names aren't adopting AI fast enough, Sally?
Companies like Ares, like Blue Owl, they've all, and Thoma Bravo, who who buy in this space or borrow heavily to fund in this space, they're probably all going through all of their portfolios right now to look at this. There are software companies out there that generate billions of dollars of revenue, and they're actually showing earnings that are accelerating, not declining. So, they're using words sort of like it's not monolithic. You don't just have this sort of very binary situation, and you do have to look at the nuances of some of the companies there. But there's some really interesting dynamics going on in the loan market. For example, CLOs, collateralized loan obligations, they're big buyers of these loans, and they have limits on what they can hold. So they may become sort of forced sellers of loans that do slip into distressed territory based on this sell-off. And again, that could pose a lot of buying opportunities, which investors have to look through and sort of sort out the good from the bad, as it were.
So interesting how John Zito over at Apollo sort of talked about questioning if the real risk is if software is dead and they'd cut their exposure by half in 2025. We'll see how this continues to ripple through the markets. Sally Bakewell with the cross-asset AI read across. Let's talk about now, SpaceX, holding meetings with banks from outside the US for its IPO, including from Europe and other regions. That's all according to sources. The meetings took place before SpaceX announced that it would acquire xAI, but the combined company is still expected to hold the IPO later this year, Ed.
Okay, coming up, Snap paid subscribers rise, but the company sees a dip in daily active users, particularly in America. Got more on those numbers next. Down 9%. This is Bloomberg Tech. Time now for Talking Tech. Let's go through some more of the earnings. First up, Sony reporting a 22% rise in profit over the holiday quarter. And it said it secured sufficient memory supply for its key PlayStation 5 business this year. The company did caution, however, that profitability of the wider games and networking division worsened due to rising hardware costs. Plus, Nvidia partner Hyde saw revenue climb 35.5% in January to the equivalent of $23 billion. The Taiwan-based company is one of the key players in the AI hardware industry and is benefiting from the billions being spent on the gear needed to train and operate the models. And shares of Peloton are down after the fitness company provided a weaker than expected revenue forecast for the fiscal third quarter. Investors have been hoping the release of AI-powered treadmills, bikes, and other new products would put some muscle into Peloton's turnaround efforts like that. Caro.
Pardon your puns. Meanwhile, let's continue this theme of earnings and those that are falling on the back of it. Snap down more than 8% amid a drop in daily active users here in the United States. Still, the company actually posted better than expected holiday quarter sales, and actually paid subscribers were rising to 24 million. So let's break it down. Mida Smiley, eMarketer Senior Analyst, is with us. It's many-pronged conversation we can have about Snap. But first and foremost, why are we seeing a decline in users in the United States?
Yeah, it's a great question. I mean, I think Snapchat definitely has kind of a stickiness problem. I feel like we see people often age out of it as they grow older. And then we're also seeing reports that younger people are not adopting it. You know, I'm talking Gen Alpha, really young people aren't adopting it at the same rate that Gen Z might have. So they're kind of in this tough spot. It's interesting. We see a lot of the other social platforms like Facebook, for instance, they're really trying to court young users. And I feel like Snapchat in some ways has the opposite issue where it sort of has a hold on this specific generation of young people. But when you go above and below that, it is struggling a bit more. And I think that is why we're seeing some of those falls.
And interestingly, you go back to November when we had the previous earnings numbers and the shares skyrocketed, not just the back of numbers, but on the back of a deal. They were meant to be getting $400 million in a mixture of cash and equity with Perplexity, a partnership on AI. Mm-hmm. Any news on that?
Yeah, I think everyone was kind of hoping this earnings call would shed a bit more light on this deal and what's going on there. Of course, they ended up saying that it's been delayed. They didn't provide a ton of detail. And it's interesting because when the deal was first announced, it was certainly welcomed by investors. I think they were excited to kind of see a new revenue stream for Snapchat and also just see how Snap is kind of looking into how it wants to compete in the broader AI race. And so to see not really any updates there is concerning. And it also just raises a lot of questions people already had around, you know, sort of why Perplexity in the first place? Why was the deal only for 1 year? How is it going to fit into, you know, how is Perplexity going to fit into Snapchat's broader interface and whatnot? So more questions than answers at this point for sure.
I'm trying to understand where Snap fits in the world. It's the first time users declined since 2018. I haven't been on Snap for a very long time. And 2018, I certainly wasn't. That sounds like a worrying signal, right? You know, you're talking about the different revenue streams, but at the end of the day, what is Snap and what does the shrinking user base suggest to you, Minda?
Yeah, I mean, I think it's a fair question, and I think that partly explains why we are seeing the shrinking user base. I think a lot of users just aren't seeing the value in it that they used to, especially as we see Instagram, TikTok, now YouTube really gain steam and just really chip away at time spent. That's something we see in our own forecast at eMarketer. I mean, we are seeing time spent on Snapchat decline year over year, at least in the U.S. And we're seeing them try to fix that. Really, that's why they're investing in things like games, and we're seeing they introduced other features last year that are really just meant to get people keep people on the app longer. But it is tricky. You know, Snapchat is really distinct in the social media landscape, which in some ways I think has worked to its advantage, but also has hurt it because it really kind of seems to struggle to keep up with the broader trends unfolding in the broader landscape. You know,
it's easy to try and compare and contrast with Meta, right? Yes. Particularly in the glasses context. You know, Meta has a generative AI tool, Meta AI, and the glasses have been the surprise package, the modus operandi by which people interface with that AI tool. Can you see the same story with Snap, with the glasses and what the point of them will be ultimately?
Yeah, I think, personally, I'm pretty much a skeptic when it comes to the smart glasses space in general. I just think it's, it still remains really niche, and I think there's still a lot of uncertainty around to what extent it will ever hit mass adoption. And I think, but even say it does take off, people do end up wanting these glasses. Snapchat is still in a tough position. I mean, it is competing with pretty much all the major tech giants who are investing in this space, who are pouring tons of resources in this space. They all have a lot more money than Snapchat. So yeah, it's interesting to see them bet on it. It makes sense with their history of augmented reality and whatnot. But I think they're in a tough position going forward in that space.
Minda Smiley of eMarketer, thank you very much. Now, coming up, we speak with Qualcomm CEO Cristiano Amon. That conversation's next. This is Bloomberg Tech. Let's focus in on Qualcomm. Shares right now down about 8%, on track for their biggest drop since last summer. At one point in the session, we were down 11%, on track for the biggest drop since March of 2020. The world's largest maker of smartphone processors issued a lackluster revenue forecast, raising some concerns that memory supply constraints could push prices higher, which in turn would weigh on the handset demand. Joining us to discuss is Cristiano Amon, Qualcomm CEO. Cristiano, good morning. Thank you for coming back to Bloomberg Tech. I give you that what's happening in memory is completely outside of your control, right? But the forecast for the current period of sales up to $11 billion. I suppose one way of looking at it is how much better would that have been were the market not so constrained by the supply of memory right now, but also the pricing pressure that supply deficit puts in place?
Yeah, look, it's a very interesting situation. In one hand, I'm incredibly happy with the business. Like, everything is going well. Demand is strong. Macroeconomic indicators are good. Demand for handset is strong. We had like a record quarter in Q1. We saw all of our customers reporting sell-through data better than expectations. But then the industry is now defined by the availability of the memory that is going to be available for consumer electronics. And it creates a sudden change in how OEMs look at their build plan, and they say, look, I have to size the size of the market not based on demand, but the memory that I can get for consumer electronics, and that what makes it like this unique period. Go ahead.
Let me jump in. But, within that market, there are some specific interesting case studies, right? The premium segment is good, like from a demand side, particularly in China. So usually, like in any hardware environment where you're supply constrained but demand is high, like that's a good thing. And increasingly, like, think about the content in the phone that you provide. How can you kind of navigate this to your advantage?
Yes. And that's a great observation. That's why I think there's a lot of unnecessary, speculation right now. Here's what's going to happen. We saw this with COVID. OEMs, the first thing they're going to do, they're going to prioritize premium and high tier, because those are more resilient, to price increases. We are going to see probably adjustment in prices on handsets, and because demand is strong, it is very likely that the premium and the high tier is going to be less impacted than the mass tier on phones. And we have seen that the premium tier continue to expand regardless. Over the several years, the premium tier is expanding, and we're more concentrated on the premium and the high tier. So your theory is 100% correct. All that happened is OEMs had thinking about a particular size of the year. That got resized by the memory availability. They're adjusting their build plans, and we're going to see how this is going to play out in the next few quarters. That's really the story. So the good thing is demand is high.
So the second quarter chip sales guidance was what worried people, but third quarter, fourth quarter, it's going to play out over that time frame, do you think?
It's one thing that I carefully worded, during our earnings call. I said the memory availability and pricing will be the defining factor for the size of the handset market. And we talk about the size of handset market because we have visibility of the whole market because of our licensing business. But now we're going to see how this play out. And I'm a little hesitant to make a very definitive prediction on how this is going to play out in Q3 and Q4, but the pandemic was a good proxy when we have something like that and we have a semiconductor shortage. We saw that the premium tier has been more resilient, and we're going to be working with our customers as they move the roadmap to kind of those type of devices.
And now you control the controllables. And those controllables have been diversification. In many ways, this speaks to why you've been focusing in on new areas of growth, whether it be autos, whether it be connected devices, whether it be the future of robotics, whether, of course, it be AI. Cristiano, how much can you accelerate there to make up for the handset issues?
Look, it's not, hopefully it's not lost on people that we had another record in automotive. We had actually a record in the company in Q1. And not only we continue to be satisfied with the direction the company is going on diversification, we added new things like robotics. For example, we had a record in automotive. A couple of things that happened in the quarter that are very, very important. One is we announced a broad partnership with Volkswagen Group across all the brands to build, the Snapdragon digital chassis for Volkswagen. We saw the launch of the RAV4, one of the top-selling cars in the world for digital cockpit. And IoT is growing. We enter robotics in a short period of time with some major customers. So we're excited about that. The fundamentals of the company are actually incredible, and we're just navigating to another phone cycle.
Cristiano, second consecutive quarter where automotive is above $1 billion. And I remember over years us discussing what was a backlog in automotive, right? Apply that story and that experience to your hopes in data center. You've told us when this will happen and who it will happen with first. But how do you see that translating from your order backlog to revenue growth and hitting milestones like $1 billion quarter? Yes,
we restated the data center will start showing up in fiscal 27. We have been talking for a while that the data center is going to change. It's going to go from the current focus on training into inference. We have been saying, I think before it was popular, that a different architecture will be required. I think the post-GPU architecture. Interesting that the Grok development is kind of validating that. And we're getting a lot of good feedback. We have a new architecture, including for memory. We don't need HBM, which is causing all of this memory situation. And we have been very encouraged by the traction we're getting. So it's going to be material in 27, and we are going to provide a lot of details in our upcoming investor event.
Just broadly, how are you thinking about the actual consumer right now as well, Cristiano? Just briefly.
Yes. So phone is a great proxy for consumer. Macroeconomic indicators are strong. Consumer demand, very strong. One of the things I said in the earnings call, sell-through data on phones, and we have visibility because of our licensing business, exceeded all expectations. Phones are getting off the shelf. So it's not a demand issue. It's just a memory supply issue.
Qualcomm CEO Cristiano Amon, we so appreciate you joining on this day after the earnings. Stay well. Meanwhile, that does it for another extraordinary edition of Bloomberg Tech. There is so much market volatility, but earnings coming thick and fast. We've got Amazon for tomorrow, Ed.
Yeah, so Alphabet has the mic drop of $185 billion Capex forecast. Is Amazon judged by the same metric? And they, communicate that differently. Recap those conversations on the podcast. 2 important CEO interviews. A lot going on. You know where to find it. Online, Apple, Spotify, iHeart, and of course on all the Bloomberg platforms. From San Francisco and New York, this is Bloomberg Tech.